Hello and welcome to the weekly market metrics. I'm your host Sandeep Rao and we are in week 16 of 2026. It was one of those unusual weeks where two very different worlds lost their giants. One from the world of investing, especially emerging markets, Mark Mobius, and one from the world of music, Asha Bhosle. In that sense, it hasn't been the best of the weeks. On the geopolitical front, there are some signs of progress, especially conversations around a potential ceasefire, with figures like J.D. Vance engaging in regional diplomacy, including a visit to Pakistan. And interestingly, despite all of this, or perhaps because of it, the market seems to be holding up quietly, absorbing all the noise. Also, technically speaking, all indices are now trading above their 50 EMA on the daily time frame, which could be seen as a bullish sign. Anyways, let's start with what happened last week and then we will move to what to expect in the coming week. Now this week, let me start by showing you some data. What we've done on this chart is identify all historical drawdowns over the past 20 years that were greater than 15%. In other words, every instance where the market corrected by 15% or more. From there, I asked a simple question. What happens after the market bottoms out? That's what you're seeing over here, the forward returns from that low point. 1 month forward returns, 3 month forward returns, and so on. So effectively, once the market hits its low during a drawdown, this shows how it has typically behaved over the next 1 month and next 3 months and beyond. The reason I looked this up is because we've recently seen a 15% drawdown from the all-time high. Naturally, the question is what tends to happen next? What's interesting is that across these instances, the forward returns have largely been positive, as you can see it for yourself. But here's a quick word of caution. This doesn't mean the market has necessarily bottomed. It's entirely possible that what we've seen so far is just an initial drawdown, and there could be a deeper correction ahead. That's exactly how larger drawdowns of 25, 30, or even 50% eventually play out. So while this data gives us some useful context, it's as important to treat it as a perspective and not some sort of prediction. It tells us what has happened in the past, not what will happen in the future. With that, let's get to our usual metrics, starting with the rate of change across indices. This week, all 4 indexes we track closed in green once again, marking 2 back-to-back weeks of gains. While this week wasn't quite as explosive as last where Nifty surged 6%, it still posted a solid 1.2% gains. Mid-cap Nifty was a standout performer at 3.23%, while BANKNIFTY and SENSEX both finished up nearly 1.2%. For the month of April, the recovery has been impressive to say the least. BANKNIFTY and Mid-Cap Nifty have already delivered double-digit returns while Nifty and SENSEX trailing just behind, up nearly 9%. In terms of the bigger picture, Nifty, SENSEX and BANKNIFTY are still about 8 to 9% away from their all-time highs. Mid-Cap Nifty, however, is the clear leader, sitting less than 2% away from its peak. Following such a powerful move last week, another green closing this week confirms the momentum is actually sustaining week on week. Let's look at Nifty on various time frames, starting with the weekly time frame. Now, following last week's Marubozu candle, Nifty managed to close above its first weekly resistance of 24,300, ending the week at 24,354. That's a gain of about 303 points or 1.26%. Talking about the range, interestingly, the weekly range shrunk significantly from 1,531 points down to just 845. This is a clear sign that volatility is cooling off as the market moves higher. We are seeing this reflected in the daily numbers as well. The 10-day average daily range was at 361 last week, but it's now dropped to 260. On the daily time frame, we saw a split with 2 green and 2 red candles. In this shortened 4-day trading week, Monday started down 0.86%, followed by a strong Wednesday at plus 1.63%, with 1.35% of it coming in the form of an overnight grab. Thursday saw a minor dip of 0.14%, and we closed the week on Friday up, being 0.65%. It's worth noting that while 1% plus moves were norm over the past few weeks, we are seeing them much less often now. Daily ranges have stayed relatively tight. Monday's range was about 352 points, but Wednesday narrowed to just 135 points, followed by 300 points on Thursday and 276 on Friday. On the hourly time frame, the index stayed above the 50 EMA throughout the entire week. Even with Monday's gap down opening, the EMA held firm and wasn't breached. Short-term trend followers have really been in the sweet spot, continuing to pull in good gains all through April. Last week, I was wondering whether the EMA would catch up to the price or if the price would pull back to the EMA. So far, we are seeing the EMA catch up to the price, and I'm hoping the trend continues this way well into the coming week as well. Talking about the Nifty weekly expiry, which happened on Monday, 13th April, the expiry day opened with a significant 1.8% gap down, but surprisingly, the at-the-money straddle opened at a premium of just 186 points. Even a gap of that size didn't manage to spike the premiums. With a starting straddle of 186 points, the actual daily range ended up being 352 points. The one saving grace for traders was the clean price action. The index trended upwards steadily without any major pullbacks. It was a tough session for non-directional sellers, but a great day for anyone playing direction. Whether they were buying or selling, it actually didn't matter. Moving to SENSEX, starting with the weekly time frame. Similar to Nifty, the SENSEX weekly candle closed right at the 78,550 resistance level. It gained 943 points or 1.22% for the week to end near 78,500 mark. We also saw the volatility cool off here. The SENSEX weekly range contracted significantly, dropping from last week's massive 4,900 points to 2,862 points. On the daily time frame, SENSEX managed only one day with a move of 1% or more on Wednesday, and even then most of that gain came from the overnight gap. For the other 4 days of the week, the price action was much more contained, with the moves staying well under the 1% mark each day. Now, talking about the SENSEX weekly expiry, which happened on Thursday, 16th of April, the at-the-money straddle opened at 411 points, but the actual day range was much wider at 1,055 points. Similar to the Nifty expiry, it was a downtrending day, but the volatility post 11:30 a.m. was incredibly sharp. We saw a 600-point drop in just about 2 hours, followed by a 500-point recovery by 3 p.m., only to see another 300-point slide in the final 30 minutes. Despite those wild swings, it was still a manageable expiry for time-based straddle and strangle sellers, especially those who managed to get into positions early in the day. Moving on to BANKNIFTY on the weekly time frame, the index gained 653 points or 1.17% for the week, closing at 56,566. This provided a solid follow-up green candle after last week's massive move. The week's range also cooled off significantly, dropping to 2,478 points from last week's 4,867 point range. On the daily time frame, BANKNIFTY found resistance around 56,850 levels. The daily candle patterns are similar to those of Nifty and SENSEX, with the index finding support at 54,350 levels. On the hourly time frame, BANKNIFTY stayed above the 50 EMA the entire week. There were some pullbacks toward the EMA on Monday, but the index never breached it. The short-term trend-following bias for both Nifty and BANKNIFTY remain long for the entire week, and it continues to stay the same. Now moving on to what to expect in the coming week. Now talking about Nifty first, on the weekly charts, resistance sits at the 24,000 and 24,150 zone. Immediate support is at 24,300, followed by this week's low at 23,550 and further down at 22,550. On the daily time frame, the immediate resistance is at 24,400, which is the current week's high, followed by 24,000 and 24,150 zone, consistent with the weekly view. Support is placed at 24,100 and then in the 23,550, 23,450 zone. Now, if you look at the straddle prices for the expected range for the upcoming Nifty weekly expiry, which is on Tuesday, April 21, it's between 24,667 to 24,041. The overall bias for Nifty is bullish, given we have secured a follow-up green candle after the strong up move seen last week. Momentum appears to be holding as we head into the next expiry cycle. Moving on to SENSEX and what to expect from it in the coming week. Well, the straddle premium suggests a range of about 1,400 points in either direction. This gives us a rough playing field between 79,884 and 77,104. On the weekly chart, the immediate resistance is at 78,550, followed by a major zone between 80,650 and 81,150. For support, we are looking at this week's low at 75,900 and then at the 72,700, 72,500 area. Switching to the daily chart, resistance is at 78,730 and then at 80,600. Supports are placed at 77,600 and 75,850. Just like Nifty, the overall bias for Sensex remains bullish as we head into the coming week. Talking about BANKNIFTY's expectations for the next week, well, on the weekly chart, the 57,100 and 57,700 zone is where the resistance sits. On the flip side, supports are at 54,350, which is this week's low, and then further down at 51,300. Now, looking at the daily time frame, that gap zone between 57,100 and 57,700 is the key area to watch, and it should act as a strong resistance. Supports are located at the 54,350, 54,400 zone and at 52,800 levels. If you look at the directional bias across the board, as I have said earlier, all four indices now show a positive short-term as well as medium-term bias. All indices are now trading about the 21 and 50 period EMA on the daily time frame. After a long time, we are finally seeing strong bullish momentum return to the markets. I hope it continues. Moving on to India VIX, well, as we've seen, the volatility is cooling off in intraday and weekly ranges. India VIX confirms the same. It dropped by 9% to close at 17.2. So finally, VIX is reverting back to its mean. Let's see where it settles. And as I've said earlier, the VIX cooling off is typically a great period for short vol traders, especially option traders. Let's see how it goes this time. And before I get to this week's sectoral performance, I want to take a step back and show you how sectoral trends have been shaping up over time. What you are seeing on this chart is sector-wise performance from the start of the year, from week 1 all the way up to week 16, which is last week. To make this easier to interpret, I have split the data into two parts. Week 1 to week 11, that is the earlier phase, and week 12 to week 16, the more recent phase. Now, visually, the sectors highlighted in green are the ones that have been appearing more frequently in the top 5 in recent weeks. And the ones in the blue are those that have faded out a bit in the recent phase. At a broad level, sectors like media, metals, realty, auto, consumption, energy, IT, and PSU banks have been fairly active in the past few weeks. But then I want to take it a step further. Now, instead of just counting appearances of the sectors, I assigned weights based on ranking. So a rank 1 in the past gets more weight than a rank 5. This helps us move beyond frequency and actually measure the strength of sectoral performance. Now, using that data, I've created a scoring system split across the same time frames early weeks versus recent weeks to see what was leading before and what is leading right now. For example, PSU banks and CPSE stocks had a strong cumulative score of 23-24 earlier in the year, and they were among the top performers. But in the recent phase, that score has dropped significantly to 3 and 0. On the other hand, metal and IT currently top the list, followed by auto, realty, media, and a few others. So the sectors you see, especially the ones highlighted in green, are the ones gaining momentum right now. And if you're tracking sectoral rotation or looking for stock ideas within sectors, this is definitely something worth keeping an eye on. Moving on to the sectoral performance for the week, well, energy tops the list at 4.59%, making a comeback after a week's pause. Then we have metal at 4.24%, again making a comeback after a week. Next is PSE at 4.08% and media at 3.77%. Realty continues from the last week and it's up 3.64%. That's pretty much for sectors this week. Moving on to commodities, well, by now you probably know my inclination towards data analysis. So I decided to run a simple correlation check between gold and Nifty. So what I've done here is analyze their relationship on a monthly basis using end of the day data of Nifty and gold mini to see how they move relative to each other. Now, if you look at March 2015, which is the first data point here, the correlation is around minus 0.37. That tells us that the relationship is mildly negative, not strongly inverse. But generally, when Nifty goes up, gold tends to move down and vice versa. But then in the same year, look at October. Now, you see a correlation which has now flipped to plus 0.32%. This means both moved in the same direction in that month. And at the rightmost end, what you see is the full year correlation calculated across all trading days in that year, giving you a more aggregated view of this correlation between the two assets. Now, here's something interesting. Focus on the full year correlation column and move toward the recent data, particularly from late 2024 into 2025 and now 2026. You'll notice that the correlation has increasingly become positive. In simple terms, gold and Nifty have been moving in the same direction more often than not. Now, obviously, that's not unheard of, but historically, it hasn't been the dominant behavior. Especially pre-2020, you would see more mixed or even negative correlations. Post-2021, however, these positive correlation phases seems to be showing up more frequently. Now, I'm not approaching this from a macro or a fundamental lens because that's not my expertise. This is purely an observation from the data. So if you have a macro view or a fundamental view on why gold and Nifty seems to be moving in sync, let me know in the comments. Now, if you have to look at the last week's performance, well, almost all metals are in green. Copper tops the charts with 4.9% gains, then silver at 3.32%, and gold is barely there at 0.26%. Crude is down 7.31%, and natural gas is flat at 0.44%. That's pretty much in commodities this week, and let's move to the summary. Well, after the explosive recovery seen last week, the markets have successfully sustained their momentum with a second consecutive green closing. Nifty gained over 1.2% this week, while mid-cap Nifty continued to lead the charge, sitting at less than 2% away from its all-time high. The most significant technical development is that all four major indices are now trading above their 21 and 50 period EMAs on the daily time frame, marking a definitive shift in short and medium-term bias to positive. Volatility continues to recede as expected, with India VIX dropping another 9% to settle at 17.2. This cooling off is reflected in the shrinking daily and weekly ranges, providing a much more stable environment for directional players. While the indexes are still roughly 8 to 9% away from their all-time highs, the consistent week-on-week follow-through suggests that the bullish momentum is firmly intact as we head into a full 5-day trading week. Moving on to what caught my attention this week, well, we've got two interesting recommendations for you, one to read and one to watch. The first is a New York Times article titled Coding After Coders, The End of Computer Programming as We Know by Clive Thompson, who also wrote the book Coders, The Making of a New Tribe and the Remaking of the World. This NYT piece explores how generative AI is changing the very nature of programming from a line-by-line manual craft to something more like a conversation. Developers are increasingly acting as architects and reviewers rather than just builders or writers of code. I see this transition firsthand. While this shift clearly boosts productivity and opens the door for non-coders like me, it also raises some very important questions, especially around job security for junior developers and the gradual erosion of core technical skills. It's a thoughtful read and definitely worth your time if you are interested in this space. My second recommendation is a video featuring the Artemis II voyage set to a stunning background score by John Boswell, also known as Melody Sheet. Watching it, you can't help but feel both inspired and at the same time, you may get a sense of what some call cosmic insignificance. That is just how vast everything is and how small we are in the grand scheme of things. As always, you'll find the links in the show notes. Now, over to the events to factor in for the coming week. Well, due to the quarterly settlement that happened last week, you must have received cash from your trading account back into your bank account. Now, you'll have to move it back to the trading account before the market opens on Monday to avoid any margin shortfall. Don't miss that. Next week is a full 5-day trading week with no holidays. Other than this, there are no major known events lined up. With that, we wrap up this week's weekly market metrics. If you find this series useful, don't forget to subscribe to the channel and yes, share it with your friends. Until then, stay curious, stay steady, and enjoy your weekend.